All right, so we get started now on module 7. In this first slide, you'll see I've got the first two questions included. The first one up there gives you the market return, the company return, and they're asking what's the abnormal rate of return given that we know what the normal alpha and beta of the stock are. Shows those calculations, and then the second question, which of those would be true, and just understand that when we talk about that random walk, it's not to say that the price can be anything, because we know prices don't jump necessarily around, from place to place, but we don't know if the next signal is buy or sell. So we don't know if it's going to go up or down, and we don't really know the magnitude. Is it a bigger step or a smaller step? But yeah, it's almost like you could flip a coin and then heads go up, tails go down, and you could just make a line, and it would look like a stock price ticker. So and problem 3, this is one of those true false type questions. So this is around market efficiency. Basically, we like to think of markets as being efficient, but we know that efficiency is along sort of a continuum, right? And sometimes it's more efficient than others, and so there's going to be things that we're going to see that would not exist in a hypothetical, sort of perfect world, but yeah, so the idea would be that if we have perfectly efficient markets, then certain types of things would not be possible. Okay, and problem 4 is much like that first problem that we had earlier, where we were looking at a known alpha and beta of a stock, and then we can see the return of the market and our return and come up with whatever the abnormal return is for that holding. Yeah, and 5 again, I think that was number 3. That had some true false. Again, this is like behavioral finance type stuff, and so just understand that that's what this is getting at, or some of these biases, right? We're human, and so we make decisions as humans do, and so that's what you're seeing there. So that was it for the 5 questions on chapter 13. I'm going to move on to chapter 14. So this problem, it's just if subordinated debt, what that means is you're going to be behind someone else in line, and so that's all that is saying. So if I'm going to get paid back earlier, then my debt tends to be more valuable than if I get paid later, right? And so that matters. Interest on many bank loans is normally floating rates. That means it changes, right? The rate will float wherever the prevailing interest rates are. Convertible bonds, you convert it into shares. All right, so it's a piece of debt and it converts into shares. That's why we call it convertible. A warrant is like an option, but it's built into this, so we call it a warrant instead. So yeah, and then you can't pay dividends on common unless you already paid your dividends on your preferred. Excuse me. All right, and then questions 2, 3, and 4 are very short, not with a lot of explanation, so I just put them on the same slide. So preferred stock, it's not debt. I mean, it is a piece of equity, but it pays a lot like debt, but essentially it's a perpetuity because they give you a flat rate. So it's this sort of hybrid security. The required return would be the dividend yield, because again, remember, we set this yield when we issue those preferred shares. Excuse me. And so, and then again, at the bottom, just calculating the average based on multiple issues. Okay. So question 5 here. It's got 2 portions, A and B. And so they just earned gross profits of 820,000. We're going to be financing this with a combination of common stock and 1.06 million in debt. This is the interest rate. They give us a corporate tax rate, how much profits available to the shareholder. And then in part B, instead of doing debt, we're doing preferred stock. The dividend yield on the stock is lower than the interest rate on debt. The corporate tax rate is still the same, right? And then we'll calculate the profit for the common stockholder in that case as well. So hopefully you see the difference there, and it has to do with when taxes come out, right? So when we pay on debt, what we're doing is we're paying interest, right? EBIT, earnings before interest and taxes. So that interest comes out before taxes. And then if it's a preferred dividend, dividends are paid after net income, right? So we've already paid taxes. So there's a distinct difference there in those. So that's what we're doing with problem 5. With 6, just understand what we're doing is we're saying, okay, is this bond more or less likely to return your money, right? And so the way to think of this, if the bond is convertible to shares, so what it means is, okay, I've got a built-in option, so therefore I've got something else of value, right? And so it's going to increase the value. If it's secured by mortgage on real estate, right? If I've got some sort of collateral, it doesn't have to be real estate. It could be a machine loan or something like that. But just anything that is secured by real property, is going to be more valuable than just a debenture, right? Which is a debt that's not tied to a particular asset. And then the bond is subordinated with reduced value. Again, we go in order, right? That's why you like to be tied to a particular asset, because that asset is tied to your debt, all right? So you get priority. And so you in the event of any sort of liquidation, you want to make sure your name is as close to the top as possible, right? But you could be willing to take lower for a higher return, right? And that's normally the case. Because it has less value, you're going to require a higher return. And then finally, the last question on this one, which are financial markets? And in the selections they gave me, it would be NASDAQ and the Chicago Mercantile. NASDAQ is the National Association of Securities Dealers Automatic Quotation System. NAS and ASD is now known as FINRA. So if you used to have NASD Series 7 and Series 66, or a Series 6 and Series 63 and 65, if you were going to be a broker, but now they've renamed that to FINRA. Right? They still use those series numbers. But yeah, so that is literally just the market of the financial computers tied together, and they create all their own books. That's how NASDAQ is set up. The Chicago Mercantile, this goes back to Chicago being the old railhead of the Midwest, right? And then they could tie into the Great Lakes system. Sorry, I couldn't think of the name of it, but yeah, all those cities along the Great Lakes could ship to Chicago, and then also it wasn't too far from the Mississippi River, and so and obviously I said the railroads to begin with. So all of that, it was a good clearing place for things. So to this day, commodities are generally get quoted at the Chicago Mercantile Exchange. And so that's what we're talking about with these financial markets. It's a place where buyers and sellers come together. The Vanguard, any fund, this is a mutual fund. This is just a holding company of stocks or bonds or some sort of investment, right? And JP Morgan Chase is not a market; they're a player in the market, right? But that's a bank, right? So they're not a market. A market would be buyers and sellers coming together. Okay? So that's it, actually, for module 7. If you do have any questions or concerns, though, please do not hesitate to let me know. I love to help you with anything. I'm sorry about my voice, but I would love to help you. So please just let me know.